Hello everyone. In this video I'm going to be talking about freight, and freight is simply the cost of shipping between the seller and the buyer. So purchases and sales of merchandise often involve freight, and if you think about it, everything we buy, somebody has to pay the shipping cost. It's either the buyer or the seller, and it depends on the agreement. So the terms of sale indicate when ownership, which is the title and control of the merchandise, passes from the seller to the buyer. This point determines whether the buyer or the seller pays the freight cost. So the ownership of the merchandise may pass to the buyer when the seller delivers the merchandise to the freight carrier. In this case, we call it free on board shipping point, and they give it the short abbreviation FOB. So FOB is short for free on board shipping point, and this is the case when the ownership of the merchandise pass to the buyer when the seller delivers the merchandise to the freight carrier. So in other words, I like to say that free on board shipping point, the ownership transfers at the seller's warehouse. So at the seller's warehouse, once it leaves the seller's warehouse, it belongs to the buyer. So this term means that the buyer pays the freight cost from the shipping point to the final destination. Such costs are part of the buyer's total cost of purchasing inventory and are added to the cost of inventory by debiting inventory. And that's also a very important thing that will be clarified in the next slide, that whenever we, as a buyer, or if I'm the buyer and I'm paying for the shipping, I don't treat the shipping as shipping expenses. In this case, the shipping cost is going to be treated as part of the purchase of the inventory price. So let's say I'm buying a computer and the computer value is, let's say, $200, and I paid $30 for shipping. So from my perspective, the cost of that computer is $230. It's not $200 and then I pay $30 for shipping and I treat them separately. No, you just combine them and you include them or add the total together as the cost of inventory. So assume that on June 10th, our company, which is Net Solutions, purchased merchandise as follows. So they purchased merchandise from Magna Data. The cost was $900. The terms were FOB, or free on board shipping point. So Net Solutions in this case took responsibility for the shipping of these merchandise once it left Magna Data warehouse. They also paid $50 on June 10th, purchase from Magna Data. So they paid the freight of $50 on June 10th, purchase from Magna Data. So let's see how the journal entry would look like. So on June 10th, you can see that we are debiting inventory and we're crediting accounts payable for $900. Why we're debiting inventory? Because we purchase inventory on account. So inventory is an asset. It goes up on the debit side whenever it's increasing. Accounts payable is a liability, and it's also increasing because we didn't pay for it. We just we bought it on account, so we're increasing the liability on the credit side for $900. The second journal entry, that's the unique one. This is the one that's related to the payment of freight. We don't record freight expense. We record inventory because, again, as a buyer, if I'm paying for shipping of inventory that I purchased, the shipping cost or the freight is going to be part of the cost of the inventory. So in this case, inventory is going to be debited for $50 and I credit cash because I'm paying cash, which is an asset. It goes down on the credit side and it's again for $50. So the ownership of merchandise may pass to the buyer when the buyer receives the merchandise, and that's the other scenario. The other scenario is that where we have free on board destination. And in this case, the title and ownership of the items would move to the buyer once it reaches the buyer's warehouse. While it's in transit, it's still owned by the seller. And in this case, the seller is the one responsible for the shipping cost. So this means that the seller pays the freight cost from the shipping point to the buyer's final destination. When the seller pays the delivery charges, the seller debits delivery expenses or freight. Delivery expenses is reported on the seller's income statement as a selling expense. And again, remember, delivery expenses or freight out, these are expenses that are going to be recorded also on the debit side because like expenses in general, they like to be recorded on the debit side. So let's see this case here, or this example. Assume that Net Solutions sells merchandise as follows. On June 15th, they sold merchandise to Kranz Company on account, $700 terms FOB destination. The cost of the goods sold is $480. And then Net Solutions paid freight of $40 on the sale of June 15th. So try to remember that whenever we are recording a sales transaction, we have to consider two things: the sales, or the selling price, and the sales journal entry, and then the cost of the items that we sold, and that would have a separate journal entry where we record the cost of goods sold. And then now we're going to add a third journal entry for the delivery expenses. So as you can see, on June 15th, we have the first journal entry related to the selling price of $700. So we debit accounts receivable from Kranz Company because we sold on account. And then we credit sales, which is sales revenue. It's a revenue account. It belongs to the credit side. And that's for the full selling price, $700. Then the second journal entry is to record the cost of goods sold. Okay, so we have to debit cost of goods sold because this is an expense account. It would be debited. And then we reduce the inventory by the amount of its cost, which is $480. Remember, we bought items for $480. We sold it for $700. So this would imply that we made a profit of $220 in this deal. So the second journal entry reflects the cost of the items that we sold. And the first journal entry reflects the selling price. And the difference is going to be reflected later on in the income statement as $220. But of course, we don't go transaction by transaction. The income statement, we combine all these sales and all the cost of goods sold, and we get the difference, which would be our gross profit. Then the third journal entry here is to record the delivery expenses. And delivery expenses, it's an expense. Expenses like to be on the debit side, and we record it for $40. And then we credit cash, which is the amount that we paid for the freight. Keep in mind that we are the ones who paid the expenses, or in other words, the sellers are the ones who paid for the delivery expenses. When the seller is paying for the delivery expenses, that's not the part of the sales or anything like that. That's a separate transaction, and this is why we recorded it as a delivery expense. So the seller may repay the freight even though the terms of the shipment are FOB shipping point. So in this case, the seller would then add the freight to the invoice. So even though the agreement is FOB shipping point, but we still charge the buyer to pay us for this. So we actually prepaid for the buyer. And then we ask them to pay the full amount, including the shipping cost on the invoice. So the buyer debits inventory for the total amount of the invoice, including the freight, and any discount terms would not apply to the prepaid freight. It would only apply to the sales transaction, but not to the shipping cost. And that's one of the common issues that some students miss. So I'm just trying to make it clear for you. So assume that Net Solutions sells merchandise as follows, and here's the sales transaction. We sold merchandise to a company called Planter Company on an account, so they didn't get cash, and the value was $800. The terms were FOB shipping point, so in other words, Net Solutions, the seller, was the one who's responsible for paying the shipping cost. Net Solutions paid freight of $45, which was added to the invoice. The cost of the goods sold is $360. So we're going to have the same three journal entries. However, the third journal entry for the freight would be slightly different because we are going to charge it to the client. So instead of having delivery expenses, we're going to have accounts receivable. So the first journal entry, very similar. On June 20th, we debit accounts receivable, credit sales for $800. Remember, accounts receivable is an asset. It's going up. That's why it's on the debit side. Sales is a revenue, and revenues, they like the credit side. So that's why we have the sales on the credit side for the full selling price. Then we have the cost of goods sold based on $360. So the cost of goods sold, which is an expense account, is going to be debited. And then we credit inventory because we are reducing the value of our inventory, which is an asset. So we credit inventory by $360. One thing I want you to remember, cost of goods sold is an income statement account, while inventory is a balance sheet account. Same thing happened here. On June 20th, this sales journal entry, accounts receivable is an asset, so this is a balance sheet account. Sales is an income statement account. And then finally here we have two balance sheet accounts, the accounts receivable and the cash. Here we are, even though we paid the cash for the shipping cost, but we are charging our client or customer with this, so we debit accounts receivable for $45 because we're going to charge the customer the total of $800 plus the $45. In total that would be $845. So this slide here just shows us how to differentiate between FOB shipping point and FOB destination. You can see here on the top diagram, the seller here, when it's free on board shipping point, the seller gives up the title or pass the title. The seller passes the title to the buyer once it leaves their warehouse. And who's responsible for the freight? It's the buyer. And you can see that the journal entry by the buyer is only recorded, but the seller does not record any journal entries. One other thing is we don't report any kind of freight expenses or shipping expenses. We just add the cost of the inventory, so we debit inventory. If the case is a free on board destination, then the title passes to the buyer once it reaches the buyer's warehouse. And the seller is the one who's responsible for paying the shipping expenses. So we have delivery expenses on the debit side and we credit cash. In some cases, the title might pass to the buyer when it reaches the buyer's warehouse, but we still charge the buyer for the cost of shipping. And in this case, instead of having delivery expenses, we have accounts receivable on the debit and cash on the credit. So I hope this figure would make it easier for you to visualize the difference between FOB shipping point and FOB destination. Now let's talk about the dual nature of merchandise transactions. Each merchandise transaction affects a buyer and a seller. And I always want you to remember that there's no way we have a transaction that only affects the buyer only or the seller only. Okay, always there's a buyer, then there's a seller. And if there's a seller, then there should be a buyer. In the book, there is some kind of comparison of the journal entries, like side by side, how these kind of transactions affect the buyer and the seller. These are not very important for me at this level, especially that we have like more discussion than we need. One more thing that we want to discuss is the trade discounts. So what are trade discounts? In some cases, wholesalers they offer discounts for the buyers when they buy in bulk, as a way of encouraging them to buy in large amounts. From an accounting perspective, we really don't differentiate that. So wholesalers are companies that sell merchandise to other businesses rather than to the public. Many wholesalers publish or upload sales catalogs online. Wholesalers often offer special discounts to government agencies or businesses that order large quantities. Such discounts are trade discounts. Let's see an example for that. So here we have sellers and buyers do not normally record the list prices of merchandise and trade discounts in their accounts. So for example, assume that an item has a list price of $1,000 and a 40% trade discount. The seller records the sales or the sale transaction at $600, which is the 1,000 minus the 400 or minus the 40% of 1,000. Likewise, the buyer would record the purchase at $600. So to simplify this, in accounting, trade discounts is not really concerning to us, because what we care about is how much cash was paid or collected. We don't really care too much about the original listed price. So, although merchandise transactions affect the balance sheet and reporting inventory, they primarily affect the income statement. An income statement for a merchandise business is normally prepared using either a multiple step or a single step financial statement. So in the next video, I'm going to be talking about multiple step income statement and single step income statement. We'll see the comparison between these two.